This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Ronnie back on the show. And when I was listening to the interview, I immediately, when he started talking about the weak commodity prices and inflation and what will turn everything and the impact it'll have on the precious metals market, I immediately thought that we were overdue for a quick little tour around in the commodity market. So I'm looking forward to doing that right now and taking a look at where we're trading on so many of these different commodities during this crazy cycle in the markets.
Patrick, I think that is an excellent topic for this week's Postgame Chart Book. Listeners, you'll find the download link for the Postgame Chart Book in your Research Roundup email. That's also where you'll find the download link for the In Gold We Trust report. If you don't have a Research Roundup email, that means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, look for the red button that says Looking for the Downloads. Patrick, as we dive into this week's Postgame Chart Book, this chart on page 2 really jumps off the page at me because what I see here is, boy, commodities in general just on a nosedive trajectory. And then we get into the COVID-19 crisis, looking at the middle of February. There's that bottom there at, 59 or so on the Bloomberg Commodity Index. And then you've got some consolidation, but never moving to a new low. Now, I don't think that we're going to have another worse crisis next week. So it looks to me like there's maybe an argument that 59 on the Bloomberg Commodities Index was a low. I mean, a final low if you think we're about to see a secular shift into inflation. But then I sort of think about it and think, wait a minute, my interviews with a lot of our guests have said you got the right idea, but that secular shift to inflation is 2 or 3 years off. We're not done with deflation yet. How do you read this as a technician, Patrick? Is this a meaningful bottom that we should be thinking might be the bottom?
Well, in technical analysis, generally, the first observation you're simply making is that the predominant downtrend has paused and we're in a consolidation phase. And determining now whether or not that consolidation develops into a major bottoming formation, because a lot of technicians could easily see that as a, bottoming formation, such as double bottoms and so on. But it also could be the midpoint of a continuation pattern. And really, I think that to step back, we have to kind of ask ourselves where we are in the current cycle, because the economy is sort of marching to the beat of a different drum than the stock market. And so we can no longer take just the bias of this V recovery in the stock markets driven by a massive flood of liquidity by the Fed, but rather commodities are really demand driven, which is about when will there be a true economic recovery. The interesting part for me is that it's going to be really hard for the demand for commodities to get worse than when you literally shut off the world economy to kind of fight COVID. I mean, so there is a legitimate chance that while the stock market may still have more bear market to go, it may be that we're in a far later inning in the cycle for commodities. And at minimum, commodities may stop going down. I mean, it's going to be hard, for instance, for, I think, crude oil to beat minus $40 to make a lower low, right? And so I think that it's entirely possible that we are seeing the bottom end of the ranges. But one interesting thing that will be very interesting to watch on commodities in general is that will we now enter a period of extended purgatory where rather than a meaningful rally, it's just we spend multiple years just consolidating along those lows. If you think about what gold did after establishing its bottoms in 2014 and 15, we still spent years discovering where the real base of gold was before the bull market started. And it's entirely possible that we're just witnessing that at this stage.
Patrick, let's move on to slide 3, gold. You asked me in the market wrap about this. What's your take on the technical analysis side of the gold chart here?
Well, the one thing that the big debate everyone's having is almost the reciprocal of what we're seeing in that commodity index, which is that you seem to have now overhead resistance on gold. And the question now are people seeing this as a topping formation, or is this simply a consolidation of that last bull run and the continuation pattern is about to come in? Now, for me, the most positive thing that gold has going for it, which it could always change tomorrow, but right now, gold broke back in April to a fresh 52-week high, and the entire consolidation has actually occurred above the February highs. And so there's an old thing in technical analysis that what were previous resistance now becomes support. And so it's really curious whether or not gold can actually hold north of 1700 in this consolidation, because that would mean that there's nice healthy accumulation that could be used as the springboard to launch yet another advance. And considering that the multi-decade highs of gold lie just north of 1900, it's entirely possible that if this consolidation holds, that gold may first try to go for a full retest of its all-time high before any bigger correction gets underway.
Patrick, something that has gotten my attention in the last couple of days is we've now got super contango, which we've discussed in quite a bit of detail and what it means and so forth with respect to oil. We've got it in the gold market now. Normally, there's a rule for contango, which is there can never be more contango than what's known as the carrying cost, the cost of buying and storing the commodity, because otherwise it could be arbitraged. If there was a really big contango from one contract to the next, somebody could buy and take delivery on the early contract, store it, and then deliver it into the next contract. Now, of course, with the COVID-19 crisis going on, the logistics of buying and storing physical gold and delivering it into other contracts is probably making those arbitrages difficult. But I think it's really important for our listeners to know, when you look at the gold chart and you see, as we're speaking on Thursday afternoon, $1,713. And by the way, it got down yesterday to $1,685. Boy, sounds like a low number. Well, that's the June contract. And if you look at the December contract, just 6 months later, it's actually gotten to the point of trading $30 of contango, a $30 premium for the December of 2020 contract as opposed to the June contract. Now, there's no way that storing that gold just for 6 months costs $30 an ounce. So that's kind of an anomaly that probably is explained by the logistic conditions because of lockdowns and so forth. But I think it's also a little bit of a signal that when we see this weakness in gold, it got down to $1,685. Well, the only thing that got down to $1,685 is that contract that's about to expire. And maybe the reason that we've seen weakness in the price is because people don't want to take physical delivery of that contract because of these logistic problems that exist because of the lockdown and so forth. It's just a little bit of speculation on my part that I could be off base on that completely, but something's kind of fishy there with that huge amount of contango. In any case, Patrick, let's move on to silver on page 4. What's this chart telling you?
Well, Eric, on silver, it's really interesting because gold was pushing basically 52-week highs on the upside, but silver was lagging in a big way. When it really got slammed back in February, March, and sold all the way down to $12, it was basically trading at multi-year lows all over again. And when gold was recovering higher, silver barely retraced 50% of its prior loss. And so the last week or two really saw silver finally trying to catch up. And so silver edged higher and now is approaching that $18 level on the upper boundary where all those highs were from September and the early first quarter of the year before the sell-off happened. And so this is going to be really interesting to see whether silver actually has the gas in the tank to also break to a 52-week high here or not. And so this is definitely one of those things to watch.
Let's move on and look at natural gas prices, Patrick. We've done quite a bit of coverage of crude oil, but we haven't really talked about natural gas. What do you see on this chart on page 5?
Well, it's interesting because nat gas continues to also have a substantial contango in it. And obviously there's seasonality and different storage issues. And a lot of the big storyline of nat gas is really will these different shale producers end up having to shut down or not? And that will substantially impact the supply demand of natural gas, at least the supply side of it. And so it's interesting that we continue to see a massive lag on nat gas on the downside, never really participating whatsoever on the turn, but it really does seem to have established the lower boundary of this current cycle. I mean, it seems that we've now throughout the year tested this kind of 160 level on the downside numerous times. And so it's really interesting to see whether or not this is finally where a short-term low established on natural gas and whether it could actually do something bullish. I mean, I don't want to say anything to get excited about it yet. I mean, there's no evidence that even the first inning of some sort of bull advance could even be underway, but it usually starts with the extended basing formation, which we can at this moment say is at least forming right now in nat gas.
Now, Patrick, a really important commodity is iron ore because it's a proxy for Chinese economic activity. Australia's biggest export is iron ore that goes to China, and China consumes a huge amount of it, making steel and so forth. You'd kind of think, boy, it must be, hitting a multi-year bottom right now because of the economic situation in China after the virus. But it looks like, if anything, we're almost on the verge of touching a new high, really, that's almost a one-year high. What's going on?
Yeah, it's very strange what we saw in iron ore. At least not. I don't want to say strange. It's certainly not what I would have expected. If you asked me what intuitively I would have thought would have happened to iron ore during this entire economic slowdown, but really it never sold off during March. In fact, it held up as we approached the latter part of March into April. It went and just retested the bottom end of its lows. And throughout the month of May has now broken to multi-month highs. We're pretty much edging to breaking out to a fresh 2020 high on iron ore. And I'm not sure what the supply and demand dynamics are driving it, but certainly this is not the type of a chart I would have been expecting when you told me that most of the world was shut down due to this COVID.
Well, let's take a look at another chart, which is a very different chart on page 7, and that's copper. But, it's kind of interesting because in many ways, copper is a proxy for the real economy. It's a proxy for industrial demand. China uses a whole lot of it. You'd think that, okay, we looked at iron ore, let's look at copper. It'll probably be a very similar chart. Totally, completely different. What do you see in this chart?
Well, this is exactly it. Like iron ore held up very well, but copper took it pretty hard. I mean, we went at the start of the year, we were trading as high as 287, and then even on an intraday basis, we're approaching $2 on the bottom end of the range during the very heavy sell-off. So very, very strong selling during the cycle. And really, the recovery looks very much like a chart on the emerging markets or something, where we had a very heavy sell-off, and it's just retracing that very like in a reflexive rally, that move on the upside. And so this to me seems far more a reflection of what I actually would have thought we would have seen in the iron ore chart, and we're not. But the interesting part that will be the real tell for me is that copper established some very important lows originally in the summer of 2019, and now the rally is just approaching a retest of that, what it will now be an overhead resistance level. And I think the real tell on Dr. Copper in terms of the health of the economy, will it be able to behave in a bullish manner and break this out? Now, I personally am quite bullish copper in the long term, in the bigger picture, but I do think it will be quite sensitive to this actual economic cycle. And so whether or not copper manages to undo all of the early part of the year selling, or whether it rolls over here, I think is going to be a really important tell that we should not ignore.
Patrick, one of the tricks of the trade that housing analysts use is they look to lumber futures as a proxy for demand in residential construction, because that's where most of the lumber gets used. What is this lumber chart showing us on page 8?
Well, I was just going to point out that isn't it amazing that the lumber chart actually echoes the copper chart. And therefore, it's the two commodities I think that are worth watching to actually really see whether there is a true V recovery coming in the economy. Because I'm more of the U-shaped recovery kind of in that camp. But yet, if we really saw copper and lumber legitimately undo almost all of that selling and recover higher, that may mean that things are a little more optimistic than maybe we're giving them. But right now, I think that lumber and copper are approaching key levels where if they were going to reject and let's say head back down to retest those lows, I'm not necessarily forecasting lower lows on either of the two commodities, but usually if there's going to be an extended recession and a prolonged period, then we should go and see a retest of the lows and establish a core base from which the major lows will or the next major bull market will use as a foundation for a rally. And so these are two commodities that I think are must watch for anyone who's really trying to get a pulse on what's really developing.
Patrick, uranium is a commodity that certainly Marion Katusa has emphasized on the program. We've had a couple of other guests mention it. But holy cow, look at this recovery profile. What's the backstory to explain why in this, even during the crisis before the recovery really began in the middle of March, you can see a bottom there and just straight up from there. What's going on?
Well, the prices of uranium, like Marin was talking about, are actually considerably below their cost to produce. And that a large part of that was because there was a huge excess supply that had to be worked through the system. And one of the things that we saw was that with this COVID shutdown, it actually shut down a whole wave of different production of uranium and a lot of the uranium mining projects, which has allowed a lot of that supply now to actually be worked off the system, which means that uranium has to more than likely continue heading to a level where it's actually economic for a lot of these uranium producers to actually produce it, which some argue is in that approaching $40 level. And so this rally, while it looks like it's been a big one, it may actually still have a little bit of more meat on the bone, and there might still be some further upside for uranium prices.
And, of course, Patrick, these kinds of chart books and little updates on the market is what you do every day at Big Picture Trading. Listeners, as described on page 10, you can sign up for a free trial at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For For more information, visit MacroVoices.com.